In 1987, Warren Buffett wrote a letter to his shareholders stating that a great investment must meet two key criteria. First, a company must have a return on equity greater than 20% for the last 10 years. And second, the return on equity for each of those years should not be lower than 15%. Citing a study that found that companies that meet these criteria are superstars and tend to outperform the S&P 500. But what is the return on equity and why does Warren Buffett like this metric so much? Stay tuned to find out. As you've heard, investing in companies with a high return on equity is one of Warren Buffett's main pillars to success. Before we get into the why, let's break down this formula. The return on equity or ROE formula is simple. You take the company's net income and you divide it by the total shareholders' equity. Think about it like this. Imagine you decide to start a lemonade stand in your neighborhood. To get this up and running, you spent $100 to buy the lemons, the sugar, the cups, and a small table. This represents the investment or the equity that you have put into the business. Now suppose that a week after of selling lemonade in your new business, you earn $120. After paying back the initial $100 investment that you made, you have now generated a $20 profit. The return on equity in this scenario is the profit, $20, divided by your equity, otherwise known as your investment, which is $100. So the ROE for your lemonade stand would be 20%. You see, the reason why Warren Buffett likes this metric so much is because the goal of a business is to generate a profit and then be able to share that profit or those profits with the company's shareholders or the investors. And ROE is a great way to measure as an investor the return that you can expect if you invest in a business. A higher ROE represents a business that is generally more efficient and able to generate higher returns, while a lower ROE business represents a least efficient company that generates lower returns for shareholders. In a second, I'm going to show you step by step how you can find companies that meet the Warren Buffett ROE criteria. But before we get into that, let's calculate the ROE step by step for one of Warren Buffett's favorite companies. You can get the financials using Y-sheets like this. Then from the income statement, we take the net income of the company and divide that number by the shareholders' equity found in the balance sheet. As you can see, Apple has a great ROE, and if you drag this function to the right, you can get this number historically for many years. With these numbers, no wonder Warren Buffett loves this company. To find companies that meet the Warren Buffett criteria, you can use a screener like the one provided by Y-sheets to get a list of companies in the same industry. Now remove some of the headers if you want and calculate the current ROE for each company. For that, you're going to need to use the TTM value so you can properly compare companies' ROE. To get the data automatically, you can use the screener get data function so that you only need to select the list of tickers in your list and then select the parameter and just click on get data so that you can see the data populate automatically for you. Now just add the ROE for the past 10 years like you're seeing right now and calculate the average and the low so that you can see if they meet this specific criteria. Now there's one more thing you need to know that differentiates great investors from mediocre ones. And that is to know that not all high ROE numbers are equal. Some industries have high numbers while other industries have very low numbers. Now you know how to calculate the return on equity for any company that you'd like to analyze, why famous investors like Warren Buffett like to look at this metric before making an investment decision. So be sure to use this information so that you can build wealth for yourself and for your family, and I'll see you in the next one.